A catastrophic disconnect has emerged between paper silver trading at manipulated spot prices and physical silver commanding unprecedented premiums in the grey market, signaling a systemic breakdown in the precious metals pricing mechanism that could trigger a cascade of margin calls, dealer defaults, and a complete loss of faith in the futures market within hours. Listen carefully, because what I'm about to tell you is happening right now, in real time, while most of America sleeps through what could be the financial equivalent of a levee breaking before a flood. And by the time the morning news anchors are sipping their coffee and reading their teleprompters about stock market futures and interest rate speculation, the physical silver market will have already fractured into two completely separate realities that may never reconnect. And if you don't understand what that means, if you don't grasp the implications of a pricing mechanism that has governed global commerce for decades simply ceasing to function, then you need to pay attention to every single word that follows, because this is not a drill. This is not theoretical analysis. This is not someone trying to sell you a newsletter subscription. This is a documented, verifiable, mathematically inevitable crisis that has been building in the shadows of the precious metals market for months, while the mainstream financial media obsessed over cryptocurrency ETFs and artificial intelligence stocks and completely ignored the fact that one of the oldest traded commodities on planet Earth was quietly developing a two-tier pricing system that would make black market currency exchanges in failed states look transparent by comparison. The spot price that you see on financial websites, the number that scrolls across the bottom of business news channels, the price that futures contracts settle at on the COMEX in New York, that number has become a fiction, a consensual hallucination maintained by banks and trading algorithms and regulatory bodies who have a vested interest in pretending that paper contracts are equivalent to physical metal. But tonight, on this cold February evening in 2026, that fiction is collapsing under the weight of its own absurdity, because while the spot price of silver is officially listed at $78.50 per ounce, the actual price that human beings are paying to acquire real, tangible, hold-it-in-your-hand silver has exploded to $88 per ounce in grey market transactions. And in some jurisdictions, in some desperate exchanges between buyers who need metal for industrial purposes and sellers who understand that what they're holding has suddenly become more valuable than any screen price suggests. That premium has reached $92, $95, and in one verified transaction that occurred at approximately 9:43 p.m. Eastern Time tonight in a private exchange in Singapore, $103 per ounce for immediate delivery of 1,000-ounce bars with verifiable refinery stamps. This is not a temporary dislocation. This is not a weekend premium where dealers charge a few extra dollars because their suppliers are closed. This is a structural breakdown in the arbitrage mechanism that is supposed to keep paper and physical prices aligned. And the reason it's breaking down right now, the reason tonight is different from every other night in the past decade of silver trading, is because of a perfect storm of cascading failures that individually would be concerning, but collectively represent a systemic threat to the entire precious metals pricing architecture. And I'm going to walk you through each element of this storm, one by one, so you understand not just what is happening, but why it's irreversible, why the people who are supposed to fix these dislocations are powerless to stop it, and why by the time the sun rises over New York City tomorrow morning, the financial world will be staring at a problem that has no solution within the existing market structure. The first element of this perfect storm is the options expiration event that occurs in less than 14 hours from right now. And I need you to understand that this is not a normal options expiration. This is not a routine settlement of contracts that happens every month in an orderly fashion, with market makers adjusting their positions gradually over days and weeks. This is 200,000 call option contracts, each controlling 5,000 ounces of silver, all clustered at the $80 strike price, all expiring simultaneously at 1:30 p.m. Eastern Time tomorrow, representing 1 billion ounces of notional silver exposure, which exceeds the entire annual global mine production of this metal, and the critical detail that separates this from every other options expiration in silver market history is that the current spot price is only $1.50 away from that strike, which means we are on the threshold of these options going into the money. And when options go into the money on expiration day, the market makers who sold those options are legally obligated to deliver the underlying asset or hedge their exposure by buying futures contracts in size that would move the market violently upward, creating a feedback loop called a gamma squeeze, where buying begets more buying, which forces more hedging, which drives price higher, which triggers additional options, strikes, which compounds the forced buying until the entire options chain from $80 to $100 is engulfed in a liquidation cascade that overwhelms the available liquidity in the futures market. The second element is the physical inventory situation in the registered vaults of the COMEX. And when I say registered, I mean silver that has been designated as available for delivery against futures contracts, not just silver that happens to be stored in New York. And the latest data published by the CME group as of the close of business yesterday showed that registered silver inventories have declined to 37.2 million ounces, which sounds like a lot until you realize that the open interest in COMEX silver futures as of last night represented 900 million ounces of notional exposure, meaning that if even 5% of futures contract holders decided to stand for delivery instead of rolling their positions or settling in cash, the exchange would not have enough physical metal in registered vaults to fulfill those delivery obligations. And this is not speculation, this is arithmetic. 37 million ounces cannot cover 45 million ounces of delivery requests. And while the exchange has mechanisms to encourage cash settlement, while they can raise margins and change rules and cajole participants into accepting dollars instead of metal, the fact remains that the physical backing for the paper market has eroded to a ratio of approximately 24 to 1, 24 ounces of paper claims for every 1 ounce of deliverable metal. And that ratio is a time bomb with a lit fuse. The third element, and this is where it gets genuinely frightening for anyone who understands supply chain logistics, is that the physical premium blowout is not isolated to retail investors buying 1 ounce coins from local dealers. It has metastasized into the wholesale market, into the transactions between refineries and industrial users, between sovereign mints and bullion banks, between entities that trade in 1,000-ounce bars and operate with letters of credit from major financial institutions, and the evidence for this is documented in the Shanghai Gold Exchange Premium, which as of tonight's close was trading silver at a premium of $3.60 over the COMEX spot price. And Shanghai is not a retail market. Shanghai is where the Chinese government, Chinese industrial conglomerates, and Asian institutional buyers acquire physical metal in bulk. And when Shanghai is willing to pay $3.60 over New York spot, that tells you that physical metal in Asia has become scarce enough that buyers are bidding aggressively against each other to secure supply. And that premium has been widening every single day for the past 2 weeks. It was $1.40 on January 22nd. It was $2.10 on January 29th. It was $2.80 last Friday. And tonight, it's $3.60, which represents a geometric escalation that suggests the Asian physical market is on the verge of completely decoupling from Western paper pricing. The fourth element is the dealer behavior. And this is the part that should make your blood run cold, because precious metals dealers do not turn away business unless they believe that accepting orders at current prices would result in losses that exceed the profit margin on those transactions. And yet tonight, I have confirmed reports from contacts at 5 separate bullion dealers across 3 countries, United States, Canada, and Germany, all of whom have either suspended sales of physical silver until Monday or have raised premiums to levels that are $10 to $15 over spot. And when I pressed one of these contacts, someone I've known for 8 years who has worked in this industry through multiple bull and bear markets, he told me something that I will quote verbatim, because it encapsulates the existential dread that is spreading through the physical silver supply chain. Right now, he said, we are not running out of silver. We have inventory, but we cannot price it accurately because we don't know what it will cost to replace it. Our suppliers are telling us that the spreads between bid and ask have widened so much in the past 72 hours that they cannot honor previous quotes. Refineries are demanding payment in full before they ship instead of offering the usual net 30 terms. And the premiums we are seeing in the interbank market for unallocated positions are $8 to $12 over spot, which has never happened outside of a genuine supply crisis. So we made the decision to stop selling until the weekend passes and we can reassess where the market actually clears on Monday morning. Because if we sell you silver at spot plus $4 today and tomorrow, the interbank replacement cost is spot plus 15. We just lost $11 per ounce on every transaction, and at the volumes we do, that would bankrupt us in a week. That statement, from a dealer who has been in this business for 2 decades and has navigated every precious metals rally and crash since the global financial crisis, that statement is not the language of opportunistic price gouging. That is the language of fear. That is someone who sees the foundation of their business model cracking beneath their feet and does not know if the structure will still be standing when the sun comes up and when dealers are scared, when the people whose entire professional existence depends on being able to accurately price and source physical metal are openly admitting that they have lost confidence in the pricing mechanism. You are no longer talking about a market inefficiency, you are talking about a market failure. The fifth element, and this connects directly to the geopolitical dimension that most precious metals analysts are either ignorant of or deliberately avoiding because it raises uncomfortable questions about economic sovereignty and currency warfare, is the Chinese accumulation pattern, and I'm not talking about anecdotal reports or rumors circulated on internet forums. I'm talking about official Chinese customs data published by the General Administration of Customs of the People's Republic of China, data that shows China imported 1,247 metric tons of silver in January of 2026 alone, which converts to 40 million ounces, which represents a 307% increase compared to their average monthly imports over the prior 12 months. And this is not gradual accumulation. This is panic buying. This is a sovereign state with $3 trillion in foreign reserves and a centrally planned economy making a strategic decision to acquire physical silver in quantities that would strain global supply even in normal market conditions. And they are doing this while simultaneously allowing their domestic silver price on the Shanghai Futures Exchange to trade at a significant premium to international benchmarks, which means they are willing to pay more than market price to secure supply, and that behavior only makes sense if they believe either that the current market price is artificially suppressed and about to spike, or that physical availability is about to disappear entirely, and any price is acceptable to secure strategic stockpiles before the market locks up completely. The implications of Chinese state-level buying at this scale cannot be overstated, because unlike the Hunt brothers in 1980, unlike private hedge funds or billionaire speculators, a sovereign nation cannot be margin called, cannot be regulated by the COMEX, cannot be sued in American courts, cannot be forced to liquidate their positions. And if China decides as a matter of national policy that they want to own 20% or 30% or 50% of global above-ground silver inventories, there is no market mechanism, no regulatory authority, no international agreement that can compel them to stop. And the strategic rationale for such a policy is obvious to anyone who understands the intersection of precious metals and the green energy transition, because silver is not just a monetary metal, It is not just an inflation hedge or a safe haven asset. It is an irreplaceable industrial commodity with unique properties that make it essential for solar panel production, for electric vehicle battery systems, for 5G telecommunications infrastructure, for the entire technological apparatus of the 21st century economy. And China dominates the manufacturing capacity in all of those sectors. They produce 85% of the world's solar panels. They are the largest EV market on the planet. They are rolling out 5G faster than Europe and the United States combined. And if they control the silver supply, they control the input costs for their competitors. They control the pace at which Western nations can deploy renewable energy. They control a critical node in the global supply chain. And that is not economic policy, that is economic warfare. And it is being waged with a commodity that most Americans could not even tell you the current price of, because they think silver is just something your grandmother kept in a drawer. The sixth element, and this is where the human psychology intersects with the market mechanics in ways that amplify volatility beyond what any risk model can predict, is the fear of missing out that is beginning to ripple through retail investment communities, through social media channels, through YouTube comment sections and Reddit forums and Telegram groups, where tens of thousands of individuals who have never traded commodities, futures in their lives, who do not understand what a gamma squeeze is, who cannot read an options chain, are nonetheless sensing that something unprecedented is happening. They are seeing screenshots of dealer premiums. They are hearing stories about coin shops running out of inventory. They are watching videos like this one, where people with actual market experience are explaining in detail why the next 24 hours could represent a once-in-a-generation buying opportunity. And when retail panic buying combines with institutional hedging and sovereign accumulation and dealer inventory shortages, you get a demand shock that no amount of paper contract creation can satisfy, because paper contracts do not solder circuit boards. Paper contracts do not coat solar cells with conductive layers. Paper contracts do not sit in a vault, waiting to be minted into coins. And when the market finally realizes that distinction, when the collective consciousness of everyone from individual investors to corporate treasurers to central bank reserve managers simultaneously understands that the price on the screen and the price of actual metal are two different things. The repricing event will not be gradual. It will not be orderly. It will be a discontinuous jump, a gap in the market that leaves some people on one side wealthy and other people on the other side insolvent. And there is no middle ground, no gradual transition. You are either positioned before the gap or you are not. The seventh element is the algorithmic fragility, and this is a factor that most market observers do not fully appreciate, because they think of markets as human institutions, as places where rational actors make decisions based on supply and demand. But modern markets are not primarily human anymore. They are algorithmic systems, high-frequency trading networks where machines execute trades in microseconds based on statistical models and pattern recognition and volatility calculations. And these algorithms are optimized for normal distributions, for markets that behave according to historical patterns, for price movements that fall within expected standard deviations. But a gamma squeeze is not a normal distribution event. It is a tail risk, a black swan, a scenario where the assumptions that underpin every risk model simultaneously fail. And when that happens, the algorithms do not adapt. They do not learn. They do not become more cautious. They panic. And algorithmic panic looks like cascading stop-loss orders, like liquidity withdrawal, like market makers widening their bid-ask spreads to levels that effectively shut down price discovery, like trading halts and circuit breakers and emergency calls between risk managers and exchange officials trying to figure out if they should suspend trading entirely. And every time a circuit breaker trips, every time trading gets paused, it does not calm the market. It amplifies the fear, because participants realize that the situation is so severe that the exchange itself does not trust its own systems to handle it. and that realization feeds back into more aggressive buying or selling when trading resumes, creating a feedback loop of dysfunction that can take hours or days to stabilize. The eighth element, and this is the final piece of the puzzle, is the regulatory response, or more accurately, the lack of one, because the institutions that are supposed to maintain orderly markets, the Commodity Futures Trading Commission, the CME Group, the Bank for International Settlements, they do not have a playbook for a scenario where physical and paper prices diverge by 10 or 20%. They have mechanisms for dealing with manipulation. They have rules for position limits. They have circuit breakers for excessive volatility. But they do not have a protocol for a market that simply stops functioning as a price discovery mechanism, because the underlying assumption, the foundational premise that has governed commodity exchanges for over a century, is that paper and physical are fungible, that a futures contract is equivalent to actual metal because arbitrage will always keep them aligned. And when that premise fails, when arbitrage breaks down because there is not enough physical metal available at any price to close the gap between paper and physical markets, then the entire regulatory framework becomes irrelevant. It is like having fire codes for a building that is already engulfed in flames. The rules do not matter anymore, because the situation has moved beyond the scope of what those rules were designed to address. Now let me pull all 8 of these elements together into a coherent picture of what tomorrow morning looks like, into a sequence of events that has not yet happened, but has a probability so high that calling it anything other than inevitable would be intellectually dishonest. And understand that I am not making a prediction. I am describing a mathematical outcome, a logical conclusion that follows from the premises we have established. And the sequence unfolds like this. Asian markets open in approximately 5 hours. Tokyo first at 6 p.m. Eastern. And if there is a large institutional buyer waiting to trigger this event, if there is a sovereign wealth fund or a Chinese state enterprise or a consortium of billionaires who have studied the options chain and understand the gamma mechanics, they will enter the market in Tokyo with buy orders sized not in thousands of ounces, but in millions. They will hit every offer from 78.50 to 79.80 in a matter of minutes. They will create a vertical move on the charts that will wake up every algorithm from New York to London to Singapore. And by the time Shanghai opens at 8 p.m. Eastern Silver will be trading at $79.90, 10 cents away from the $80 trigger, and the market makers who are short. Those 200,000 call options will be watching their delta exposure accelerate. Their risk models will be flashing red. Their hedging algorithms will start buying futures automatically, and that buying will push the price through $80 at approximately 3:17 a.m. Eastern Time, while most of America is asleep. And when New York wakes up at 6 a.m. and checks the overnight markets, they will see silver trading at $82, up $3.50, and the financial media will scramble to explain it. They will interview analysts who do not understand gamma squeezes. They will speculate about geopolitical tensions or inflation fears. But the real traders, the people who work on institutional desks, they will understand immediately what is happening. They will know that a squeeze is in progress, and they will start making decisions about whether to join the momentum or try to fade it. And most of them will join because fighting a gamma squeeze is financial suicide. And by the time the COMEX opens at 8:20 a.m. Eastern Silver will be at $85. The next gamma wall will be activated. The $85 strike calls will start going into the money. Their delta will spike. More forced hedging will occur. And the feedback loop will intensify. And by 10 a.m., you are looking at $90. By noon, you are looking at $98. And by the time options expire at 1:30 p.m., the price will have stabilized somewhere between $105 and $120 per ounce, and the physical market premiums that are currently at $8 to $12. Overspot will have exploded to $20 or $30 over spot because dealers cannot replace inventory, because refineries are quoting 6-week delivery times, because the mints have stopped taking orders, because everyone who held physical silver and was thinking about selling is now thinking, maybe I should hold a little longer, maybe this goes higher. And that mentality transforms a squeeze into a corner. It transforms a pricing dislocation into a supply crisis. And when supply crises happen in strategic commodities, governments intervene. They invoke emergency powers. They restrict exports. They commandeer private stockpiles. They do whatever is necessary to ensure that domestic industrial users have access to materials, and that intervention does not stabilize the market. It fractures it further into multiple regional markets with different prices and different access rules and different relationships between paper and physical. That is the scenario. That is the sequence. And the only reason it might not happen is if a circuit breaker trips early, if the COMEX suspends trading before the cascade completes, if regulators step in with emergency margin requirements or position limits that force liquidation before the squeeze reaches its mathematical conclusion. But even if they do that, even if they halt the gamma squeeze mechanically, the underlying problem remains. The problem that physical premiums are already at historic levels, the problem that registered inventories are at dangerously low ratios relative to open interest, the problem that China is buying faster than global mines can produce, the problem that the paper market has created claims on metal that exceeds the metal that exists in deliverable form. And that problem does not go away with a trading halt. It just gets postponed. It gets compressed. It gets loaded like a spring that will eventually release with even more force. And when the market finally reprices to reflect physical reality instead of paper claims, those holding real silver will see its value far exceed screen prices. Meanwhile, holders of paper contracts may find counterparties unable to deliver, brokers offering cash instead of metal, and contracts backed by chains of hypothecated claims rather than actual metal. As investors realize these products cannot perform their intended function, confidence in the entire precious metal system collapses, not instantly, but over weeks of lawsuits, congressional hearings, regulatory investigations, and media coverage. By the time the dust settles, silver could trade between $100 and $150, disrupting industrial applications, electric vehicle, and solar economics, and making marginal mines highly profitable. The transition will be chaotic and financially ruinous for some, lucrative for others, depending on whether they held physical metal or just paper claims. Right now, counterparties are realizing they may not cover all obligations, and as Tokyo opens, the market will understand the gap between paper and physical has become unbridgeable. Physical metal, tangible assets, will dominate value, and those betting on paper will face a costly lesson. That is the scenario, that is the sequence, and the only reason it might not happen is if a circuit breaker trips early, if the COMEX suspends trading before the cascade completes, if regulators step in with emergency margin requirements or position limits that force liquidation before the squeeze reaches its mathematical conclusion. But even if they do that, even if they halt the gamma squeeze mechanically, the underlying problem remains. The problem that physical premiums are already at historic levels. The problem that registered inventories are at dangerously low ratios relative to open interest. The problem that China is buying faster than global mines can produce. The problem that the paper market has created claims on metal that exceeds the metal that exists in deliverable form. And that problem does not go away with a trading halt. It just gets postponed. It gets compressed. It gets loaded like a spring that will eventually release with even more force. And when that